Hello everybody, so I'm continuing my series of my favorite stocks and I'm going through each different sector. Today is an update on the payment stocks, those that I find the best right now. And I happen to own the three stocks that I find the best in this spreadsheet. I find that Shift4, StoneCo, and Dlocal to a lesser extent. Dlocal is a lesser position for me. I find that these three stocks are particularly compelling. I also don't think anybody could be faulted for owning PayPal or Square. It's just that for me, being a growth snob, the growth is a little too slow, and the valuation, how much am I paying for that growth for a PayPal or a Square, is a little too high, especially for PayPal. That growth is very expensive on PayPal for only 8%. But PayPal also has a lot of good things going for it. So let me just go ahead, get started. Tell me, let me tell you, arguably in my view, the most compelling stock, which I own here, is Shift4. So that's my second biggest position in the sector, Shift4. StoneCo is still my number one position. StoneCo, remember, was growing much faster in the past. Their revenue growth has stalled. But Shift4 is still growing very fast. Their next 12 months sales estimate for the next 12 months is 32%. So we are well above the 15% threshold that I try to beat in order to beat the denominator, beat the dollar growth. Gross margin is 27%. EBITDA margin is 14%. Again, these are payment companies. These are tolls, right? Toll on the velocity of the money, toll on the flux of money. That's how these companies have their profits, right? And this company, Shift4, well, it's a rule of 46, so it beats the rule of 40 in software. Shift4 is founder-led. Shift4 has a very interesting CEO, a guy in his late 30s who's also the commander of a SpaceX rocket. I don't know if that's good or if that's bad, but he's clearly a techie. And that CEO, if you listen to a few calls of Shift4 like I have, that he was trying to sell the company, didn't get the price he wanted, and therefore the stock dropped quite a bit. And we're still about 50% down from rumored acquisition prices. And so that's why a lot of people, including myself, I suppose, think the stock is likely 50% undervalued compared to what they were putting themselves up for sale. I don't buy acquisition plays or acquisition stories. I buy and hold stocks for the long run. I hope the acquisition of Shift4 is now off the table and that this company is going to continue to be a leading payments processor in the United States, leading card reader in the United States. Worth mentioning that Shift4 has a top-down sales approach. They sell to large chains at first, large hotel chains, stadiums, etc., and they are slowly moving down the size of the businesses. They also have a thriving restaurant segment, for example. So Shift4, in my view, this company has a lot going for it. I'm happy to own it, and it is cheap right now, right? EV over forward revenue, for example, is only 1.8, right? And notice how most of them are cheap for payment processing companies, which are essentially a sure way to make money, right? You're just a toll, right? So they're pretty cheap in my view. Moving on to StoneCo, STNE. Big darling of the channel. I talk about this stock a lot. I like this stock very much. I love it more than ever. I would say it's right now my second favorite. It's my second favorite out of always, only because I'm a growth snob, and I don't think that 14% growth over the next 12 months, I don't think that's going to stay. I think this is a company that's going to grow again as they start implementing loans to small businesses. That's going to be the next phase of their growth. I think StoneCo is going to keep growing and outperforming. But in the meantime, as I like to joke, StoneCo, STNE is in the cash piling business. Look at this EBITDA margin, 50%. You're talking about MasterCard / Visa type margins, perhaps a tad lower. This is a business, StoneCo is a business that's highly optimized for profitability. It's highly optimized, as I like to joke, for cash piling. They've been piling a lot of cash and they plan on doing some lending with that cash to earn even more revenue. We'll see how that goes. They're very prudent with that, and they're going very slowly, moving very slowly with that, because they know that the market will not forgive them a second time if they had a collateral issue. This stock dropped a lot now 3 years ago because when they went into lending in Brazil at first, they had a collateral issue. By the way, I don't think I mentioned that. If you're new to the channel, STNE is a payments company for small businesses, 3 million small businesses, not micro businesses, small businesses in Brazil. And a small business in Brazil is something considered like a restaurant, like a small grocery store, a small department store, right? A country like Brazil has also micro businesses. They have a micro business offering at StoneCo, STNE, but that micro business offering is only second to Mercado Libre, which is best for micro businesses. They have a well carved out niche over there. And as a result of this outstanding EBITDA margin, right, my proxy for cash flow, as a result of this, cash piling, they achieve a rule of 64 despite only, quote unquote, only having 14% forward sales growth. So an outstanding number here. Moving on to PayPal. PayPal, one of the most heavily promoted stock on YouTube, a stock that I do not own, a stock that, I could argue is cheap if you compare to, what it was trading at in the past. But in this spreadsheet right there is the most expensive on an enterprise value to forward revenue basis. It's also the most expensive on a growth basis. Enterprise value over gross profit over revenue growth, which you see right here. You see it. You can see it's a 0.74. So how much am I paying for that growth? I'm paying a 0.74 for each percentage point of growth. That is expensive. That is not a cheap stock, and it doesn't achieve, unfortunately for it, it doesn't achieve a rule of 40. It's at a 27. And of course, I can't really blame them for that. They're not growing fast enough. They have too much revenue. Right, you're talking about a company that has 10 to 15 times more revenue than either Shift4 or StoneCo. So how can you grow that much faster? PayPal, when you're PayPal, you're competing head to head with a Visa, American Express, MasterCard. It's tougher competition. They're already the leader, right? They've had a 20-year head start. I think PayPal does a few interesting things, especially I'm especially compelled with the PayUSD, the PayUSD, the stable coin that they issued on Solana and on a few other blockchains. I'm quite compelled by that. It's kind of maybe have a circle type play, USDC or a little tether play, maybe in PayPal. So maybe they're moving into crypto. If they were to double or triple down on crypto, then I could start comparing that stock to, say, a Coinbase, and I would find that more compelling. It'd be a way for them to propel their growth. But that growth at 8% for me right now, it's too low. Not a stock I'm interested in. Not my style. If someone is a value investor, and many people on YouTube are, YouTube Finance is like one of the favorites of YouTube Finance is deep value investing, or like value investing or dividend investing. Well, that stock would be very popular with that crowd. Moving on to Square. So Square, it's a company that's too expensive for me. Because if you look, well, okay, so it's 0.29. So you may say, oh, it's not that far off from a Shift4. Yeah, but also, let's assume it has the same, how much am I paying for that growth type pricing as Shift4. Shift4 is growing twice as fast. Shift4 is growing at 32% next 12 months sales. Square is only 16%. Square has a huge base, right? 23 billion in revenue. You're just not going to be a stock that grows that fast. And look at the EBITDA margin. The EBITDA margin is also the lowest out of all of the stocks there. So even though, as you know on this channel, I don't invest for cash piling, I want businesses to reinvest heavily. It's still low compared to what you can get elsewhere, right? It's still better to have a business cash pile than to have the business not make that much cash. And right now, Square is just not that profitable of a company, in my view. And so that's why it's trading at 40 times EBITDA, right? That's quite expensive when you have a STNE trading at 4 times EBITDA, right? Or PayPal or 4. So it's expensive across the board. It's not growing that fast. Yeah. But, it's true they have Cash App. Cash App is the leading payment app in the United States. It's ahead of Venmo. Most people use Cash App. Most contractors use Cash App. Small businesses use Cash App. They just have their cash tag and people just scan it. So they are the leader. They are, quote unquote, the safer payment network out here. But that's why you don't achieve a rule of 40, and that's why you're that expensive. And the last company is Dlocal. Dlocal is the joy of short sellers. Short sellers love to bash and bash and bash Dlocal to the point that whenever a stock goes back up, boom, you have a new short seller that comes out and has something else to say about Dlocal. Square, by the way, was also the attack of a short seller, famously. So you know what I mean. It's very annoying. If you're in the stock for a short-term trade, which I never do short-term stuff. But if someone is in the stock for a short-term stuff, then it becomes very annoying. If you're in it for a weighing machine, if you're in it for the next 10 years, then in my view, I believe it's a stock that one can own. No investment advice, no financial advice, of course, but it's a stock that I can own because I'm willing to wait. And over time, the stock market is a weighing machine. And so this company, I believe, is undervalued. Shift4. Dlocal, really briefly, they specialize in payment processing for emerging nations for online payments, and they specialize in commercializing the products of big business. So they have that top-down approach, just like a Shift4, top-down approach. Unlike a Shift4, Dlocal focuses online and only on emerging nations. Shift4 focusing top-down, physical, in rich nations, mostly the United States, but they're entering Europe. And Dlocal is a very compelling, cheap stock, trading at 11 times EBITDA, only 1.9 times for revenue, and the growth is the best out of the bunch. Out of all of the five right now, the growth predicted next 12 months for Dlocal is a 33%. So that's pretty high right there. And the rule of 40, they just break through the rule of 40 out of 55. So I like it. But you gotta, make sure you wear your seatbelt because this one is a very, very volatile one. So 4, STNE and Dlocal, they're my favorites. PayPal and Square, they're too big for me, too big for my style. If you're closer to retirement, if you don't like a roller coaster, if you like very stable companies, I could get it. PayPal, I could get behind if I were to get a little more into crypto. But for now, I'm out of these two. And this is it. This was my update on payment stocks. So remember, not investment advice, no financial advice ever on the channel. This is just entertainment. Please like, please subscribe. Thank you for watching and have a wonderful day.